Hello, everyone. Good morning, afternoon, evening, wherever you might be. Welcome to this CGAP webinar on the systemic approach, a framework for sustainable change. My name is Molly Tolzman, and I'm one of our presenters today. Thank you all for making the time to join us, and we look forward to sharing with you during this webinar. So before we dive in, just a little bit of background on CGAP's experience in this topic, and we'll cover a couple of logistical points about the webinar as well. As many of you likely know, CGAP is a global partnership of more than 30 leading development organizations that works to advance the lives of poor people through financial inclusion. And to generate sustainable change at scale, CGAP advocates for funders of financial inclusion to adopt a systemic approach that triggers systemic change. This approach is about considering all aspects of a market system and nudging market actors to take up missing or weak market functions. You can find more information on our website using the link provided on your screen. And specifically, two keystone publications that we've put out on this topic, a market systems approach to financial inclusion, some guidelines for funders from 2015, as well as a handbook on measuring market development from 2017. We'll include these links in the webinar chat box now, which you should see on the right side panel of your screen, and we'll also share them with you after the webinar. In addition to resources, CGAP offers training opportunities, both face-to-face courses for members, as well as an e-learning option, which is free and open to all. Speaking of the e-learning, this webinar was designed to complement our free e-learning course powered by Gateway Academy, which launched about 6 months ago. Some of you with us today have already taken this course or part of the course. And for those of you who have not, you can check it out at gateway.academy/funders. The course is split into 2 modules, the first of which serves more as an introduction to financial inclusion, and the second focuses more on the systemic approach specifically. It's self-paced. You can take one or both modules, and it takes about 3 hours to complete both. So we definitely encourage you to share with any colleagues or partners for whom it may be of interest. So in this webinar today, we are going to focus on this topic of systemic change, which can be pretty challenging to enact. We're going to introduce a framework during this webinar to help you design for systemic change and monitor whether it's happening in the context in which you work. We're going to start off today by outlining what we mean by systemic change. Then we'll cover what it takes to do so using a specific framework known as AER to plan and monitor systemic change. We're going to talk through the examples of M-Shwari in Kenya, as well as a policy reform process in the Philippines, to give you a real sense of what this looks like in action. And then we'll have some time for questions at the end of the webinar. We have with us today my colleague Elise Negra, who's based in London, and she is one of the creators of the CGAP e-learning course on the systemic approach that I mentioned a moment ago. Elise works broadly on various efforts to promote a systemic approach to financial inclusion. She's authored numerous pieces on financial inclusion topics related to market facilitation and aid effectiveness. She has nearly 20 years of experience working in financial inclusion, which has included a diverse range of roles, such as launching and managing a microfinance rating agency, advising governments, sitting on the board of MFIs, supervising research, facilitating market-wide consultations, and evaluating various development agencies and training their staff. And as for me, I'm Molly Tolzman. I'm based in CGAP's Washington, D.C. office. I work on our member engagement and sector support work streams, which means that I spend most of my time on topics of funder coordination, funder trends, funder guidance. I've been focusing on financial inclusion since 2014, and my background is in qualitative research and information design. So just a few final logistics before we get into the core of the webinar. This is an audio broadcast type of webinar, which means that attendee microphones will remain muted through the entire webinar session. If you would like to ask a question during the webinar, we ask that you please use the chat box, which you should see on the right-hand side of your WebEx session. You can submit your question at any time during the webinar presentation. We may touch on some of them during the flow of our presentation if it's relevant. Otherwise, we'll have some time at the end. To ensure that we see your question, please select the option for all participants when sending your question through the chat box. And finally, the webinar recording will be emailed to all attendees and registrants after the webinar, along with any other links and resources we have to share with you. And so with that, I will turn it over to Elise to get us started.
Hi. Thank you, Molly. So let's get started with the systemic change. Before we talk about the framework, this AAER framework that we wanted to introduce, I just wanted to spend 5 minutes making sure that we all have a similar understanding of what systemic change means. So let's talk about systemic change, and first let's talk about a system. What is a system? So as I guess you know, a systemic will relate to a system as opposed to a particular part. So let's see how we define a system at CGAP. And actually CGAP is using the system representation that was developed by the Springfield Center, as well as the AAER framework actually. So at the center of a system, we have the transaction happening between the demand and the supply. And this is the market we want to influence. So for financial inclusion projects, our market would be the demand and supply of financial services. And we want to make sure that this transaction is inclusive. But for those two, demand and supply, to meet, we actually need a number of additional functions. We identify two types of functions. First, the support functions. Those are the functions that shape, inform, and enable transactions. So let's go through a few examples. If we take the financial services market, support function would include things like information, infrastructure, technology, capital markets, skills development, and these functions will be provided by research firms, for instance, agents or ATMs, network managers, training centers, credit bureaus, audit, rating agencies. All those are functions that will enable the supply to meet the demand. What's the second one? The rules. The rules can be formal, such as those coming from policymakers, regulators, supervisors, industry networks. So for instance, we would have a financial inclusion strategy, financial sector regulations, international banking standards, or KYC regulations. You could also have codes of conduct developed by an industry network. You could also have informal norms or even just practices. For instance, norms that shape how people will use financial services. Do people trust digitized payment instruments, or do they still want to use cash? Do families accept that women open personal bank accounts, or that they transact with med agents? All those informal rules will really shape the transaction at the core of the market. So the rules are the functions that will govern how transactions happen. They can be both formal or informal. And together, the support functions and the rules will shape the transactions. So the better they are, the greater the number and value of transactions in our core markets. In a way, the support functions and the rules are the mechanism that will move us from the market to the market system. Then, if this is a system, what is a non-performing system? It's a system where the supply does not meet the demand. So it can be the quantity, the quality, or the price of the services that don't work for the demand, or maybe even a combination of 2 or 3 of them at the same time. In our case, the system is not performing when financial services do not help the poor, or farmers, or women, or youth, or refugees, or any specific segments that you are targeting to achieve positive outcomes, improve their living conditions. This is a non-performing system. How do you fix it? Well, first, you know, like 30 years ago, we focused on improving the supply. So funders and development practitioners focused on creating new financial institutions that would specifically target those population segments. However, creating new institutions does not address issues at the other levels, the support functions and the roles. So after realizing that those support functions and the roles were probably, maybe mainly the constraints that were preventing supply to meet demand, we started addressing gaps at this level. So we started trying to fix regulations, setting up credit bureaus or training centers, or developing financial inclusion programs, etc. And yet today, after many decades of support, we see that financial systems are better, but they still exclude large parts of the population. Why is that? Because a change in the system is not necessarily systemic change. When we focus on fixing individual elements, changing individual or particular parts of the system, it does not necessarily lead to how the system overall behaves. So creating a new supplier or improving the regulation or putting a new credit bureau in place might lead to the system performing better, but not necessarily. And this is the difference between a change in the system and systemic change. I like this example from Owen Barder from the Center for Global Development. He uses an interesting metaphor to explain why changing a particular part in the system often does not change how the system works. And those of you who went through the e-learning know already this quote, but I will recap it here because I find it very powerful. So if you think of a ping pong ball in a glass bowl, like the image you currently have on your screen, if you're not satisfied where the ball settles, you can move the ball somewhere else. So you can create a credit bureau, you can draft a new policy. But when you let go of the ball, when you leave the sector, the ball will just roll back to where it was before, where the equilibrium is. So if you add a credit bureau in a credit market, if the other markets do not adapt how they work, then the credit bureau won't have much impact on the market overall. The system will continue to work as it used to. Changing the system requires changing when the equilibrium settles. And just another way to put it is this quote from Rob Riccigliano, from the Omidyar Group. Systems are not broken. They do exactly what they are designed to do. So you cannot fix them. You cannot fix them by just creating a new supplier or improve a specific regulation. We need to change how the system works overall. So it's the dynamics of the system. And this is what we aim for, systemic change. I will stop here for now. Please remember to use the chat box on the right of your screen to submit comments and questions, and we will go through them and answer what we can at the end of the webinar. Now Molly is going to take us through the framework that we want to introduce.
Thanks, Elise. Could you pass the presenter back to me, please?
I am trying, but it doesn't want. Here, sorry.
Yes. No worries. All right, so that was a really interesting, I think, description of, sort of the whole exercise of systemic change and the fact that you can't, just institute an individual fix, but really it's about changing the whole system. But what exactly does it mean to change the dynamics of the system? The AAER framework developed by the Springfield Center can help us unpack this a little bit. So to generate sustainable change at scale, we want to see several things happening. First, an initial pro-poor innovation that is owned by market actors. It is maintained, sustained, and improved over time. And it has an impact on the entire system. Other functions will stabilize and even augment the impact of this innovation within the system. So the AER framework helps to show us how this unfolds. First, we have A for adopt. You start with the initial innovation by the funder's partner. After adopt, we have our second A for adapt, where the partner incorporates the innovation into their operations beyond the funder's program or other intervention with independent resources, not those of the funder. Both of these phases happen at the partner level, but we also want the dynamics of the sector to change beyond the partner. And so for that, we look to E for expand, where market actors who play the same role as our partner copy or add diversity to the innovation, and then R for respond, where other market actors adjust their practices. And this leads to that sustainability and scale that we're really trying to achieve with this approach. So let's look at an example of AER and the systemic approach in action using M-Shwari in Kenya, a product with which many of you may be familiar. So M-Shwari means calm in Kiswahili. It's built on the M-Pesa product, probably familiar to many of you, the mobile phone-based money transfer and payment service offered by Safaricom and MNO, which provides a combined savings and loan product. That's M-Shwari. People report mainly using it to manage fluctuations in their cash flow and to cope with unexpected needs. It was launched in 2013 through a collaboration between the Commercial Bank of Africa, CBA, and Safaricom. And FSD Kenya has played a key role in facilitating the development of M-Shwari. So what are the results? Well, 2 years after its launch, M-Shwari boasted 9.2 million savings accounts, representing 7.2 million individual customers. They had deposits of 45.3 million US dollars and 17.7 million in outstanding loans. So to put this in perspective, only 700,000 people in Kenya had a personal bank loan when M-Shwari was launched, and just over 300,000 had loans from an MFI, which is a huge increase in the number of people who are being served by financial services. It's since been copied in Kenya, and CBA has expanded the service to other African countries, and it now serves as a platform for other financial services as well. So in other words, it really changed the way that markets work for the poor. And let's look at this systemic change in more detail. So in the AER framework, the first step is the innovation. In the case of M-Shwari, it was a product innovation with impressive results. The partner, CBA, changed its attitude and behavior regarding the mass market and invested massively in this project, which led to the adoption of the innovation both by the partner and its clients. On the first day of its launch, CBA received 1 million inquiries, and they had reached 1 million customers in only 41 days, compared to something like Facebook, which took 10 months to get to 1 million customers. It reached break-even in 11 months, which was twice as fast as predicted, had 5 million clients within 12 months, and 7.2 million within 24 months, which is pretty incredible growth. And so this is our adopt phase. The initial innovation is taken up and is viable. But even though this is an impressive change in this situation, it's not yet systemic change. Systemic change is about sustainability, and we want to see how this innovation is sustained and improved by the partner. So here, FSD Kenya and CBA noticed that only 19% of customers were below the poverty line. Together, they decided to segment the clientele, to adapt the marketing and account management, and to revise the credit scorecard to increase the acceptance rate. After these actions, then 30% of customers were below the poverty line, and more than 1 million discernibly poor users were able to access credit. The portfolio quality remained high, only 5% of loans defaulted, and CBA continued to innovate on this with something called Lock Savings, which pays an additional 1% interest for users who leave deposits for 1 to 6 months in a term account. This is what our adapt stage looks like, where the partner, CBA in this case, fully owns the innovation, incorporates it, builds on it, continues to upgrade it. Then beyond CBA and its clients, this innovation impacted the whole market system. So first, it crowded in competing players in Africa. After CBA's 2-year exclusive deal with Safaricom, Safaricom also partnered with Kenya Commercial Bank, KCB, to launch KCB M-Pesa. In the first 6 months, KCB M-Pesa attracted 1.4 million users. CBA also expanded the M-Shwari product to other countries within its network, including Rwanda, Uganda, Tanzania, and Cote d'Ivoire. This is a great example of what the expand phase looks like. Actors that perform the same function as the partner, so our original partner CBA, perform that same function and add to the innovation. So here, CBA competitors launched similar products in Kenya, and other actors, including CBA itself, were able to expand and launch products in other countries. So beyond competing actors, M-Shwari also changed the way that other market actors behaved. On the regulation side, in October of 2016, a debate on transparency was launched in Kenya. The Consumer Federation of Kenya sued CBA and the Central Bank of Kenya, who's the market regulator, for non-compliance with lending rates on M-Shwari. They accused M-Shwari of bypassing interest rate caps by charging what they labeled as facilitation fees. So in 2017, the regulator issued a Digital Financial Services Transparency Order, and initial results from a CGAP impact study indicate that this has triggered a variety of improvements in the market that have brought about greater consumer switching, shopping around, and price awareness. Other operators, urged by the regulator, have taken steps to improve competition, and this to curb Safaricom's dominance by imposing interoperability, and solutions for that are underway now. On the product side, M-Shwari catalyzed a wider innovation ecosystem, one example being Hello Doctor Kenya's launch of SimaDoc, which enables users to save and borrow money for medical expenses via their mobile phones. It's a subscription-based service, offers benefits like telephone diagnostic service, SMS prescriptions, and a cash lump sum if admitted to the hospital. So this is our 4th phase, respond, where non-competing actors, here including regulators, consumer protection associations, suppliers of non-financial services, all also adjusted their practices in response to the innovation. So to recap the AER framework in this case, A for adopt. First step, the initial innovation by the funder's partner. So CBA took a new attitude to the mass market, launched an innovative, viable product, M-Shwari. Second, adapt, the sustained change of the partner. Here, the partner incorporates the innovation into operations beyond the funder's program with independent resources. And CBA tweaked their product offer and made other improvements to reach more low-income customers. Now remember that we want the dynamics of the sector to change beyond the partner. So we have E for expand, market actors playing the same role as our partner who copy or add diversity to the innovation. Here, competing actors launch similar products in Kenya as well as others abroad. And then finally, R for respond, where other market actors adjust their practices. In this instance, regulators and other service providers responded to the change. So the horizontal axis of our AER framework represents scale. Adopt and adapt are at the partner level. They're about the initial innovation. Expand and respond enable scale, moving beyond the partner. Now, along our other axis, we have sustainability. The adapt and respond phases are at the top of the framework, and they are necessary to ensure that the solution is sustainable, because this is where the innovation is really embedded into the partners and other system actors' practices. We saw all of this just now in M-Shwari, which is a pretty solid example of employing a systemic approach to ground sustainable change. So before we look at another example, just a quick reminder, if you have questions, please send them through the chat box at any time during the webinar. And with that, I will give it back to Elise.
Thank you, Molly. We wanted to show you another example of systemic change, and Molly just took us through an example triggered by an innovation at the supply level, M-Shwari being the supplier of financial services. So remember the system representation that I shared before. You can also identify constraints at the support function level or at the rules level. And being active at those two other levels doesn't necessarily mean that you will trigger systemic change. It's this ping-pong ball issue in the glass ball. So here we're going to talk about a program that focused on another level and see what using the AAER could mean with this, with working at a different level. So, sorry. So our example, the funder supported an innovation at the rules level. Let's see how it plays out. We will travel to the Philippines and look at rural financial services in the early 1990s. In the early 1990s, following 2 decades of President Marcos' authoritarian rule, we had President Aquino and then President Ramos who wanted to open up the national economy, reduce corruption, encourage private enterprise. So to lead this change in the financial sector, they created a national council. The council aimed at improving the restrictive regulations in place and reduce state involvement, because at that time the state was heavily involved in providing credit to low-income and rural populations using what was called directed credit programs. So this is where government agencies indirectly provide subsidized credit to specific segments of the population. But the reform, although it was a public national council, the reform process stalled. The first attempts to reform the policy were totally unsuccessful. And so if you look at the end of the decade, in the late 90s, the law still mandated banks to allocate credit to specific sectors. There were more than 100 directed credit programs active, and the financial outreach still remained very low. There were some banks, well, actually many banks in rural areas, but these banks lacked capacity and even the interest to serve low-income and rural population. So even though the government wanted to change the situation, nothing much was happening. Now, if you fast forward just a year later, in the early 90s, what do we have? We have enabling regulations, authorities who keep innovating, changing, and we have more than 170 rural banks involved in microfinance, with more than 400,000 microfinance customers in 2002. The subsidized credit programs were all terminated, or they were transferred to government financial institutions who knew how to manage them. Very different dynamics. And even this positive change lasted for more than a year. The National Microfinance Strategy that was approved was the starting point for what became a regional success story. So in 2016, when CGAP collected data for the case study, the rural banks were still very active, and they were serving 2.6 million microfinance customers, from close to none in the early 2000s. The regulators continue to adapt, innovate, and respond to market changes. So we have there very different dynamics. What happened? Many things, including a program for USAID that largely contributed to this change. We are going to use the AAER framework to see what happened. So it all started with a different type of analysis. The issue was that there were only limited and unsustainable financial services in rural areas. Most funders at the time focused on improving the supply, so creating NGOs or refinancing institutions so that they would work with low-income populations. But USAID and the Council took a system view, and they tried to identify constraints in this broader system. Their diagnostic identified inadequate policy as the main constraint to inclusive financial services. So here we are at the rural level. But the diagnostic went even a step further. The poor regulations, the inadequate policy were just the obvious gap. And USA tried to identify root causes, the root causes that create this gap. So was it the capacity of the regulator? Not really. The regulator knew how to draft financial policies. They were aware of best practices. They really wanted to change. The good thing is that USAID had actually been involved in the country for years, and they have frequent interactions with various market players, and they went in the rural areas and talked to rural banks, to clients, to funders, other funders who were involved there. And they realized that the reform process stalled because of conflicting ideas within government agencies. So there were several government agencies beyond the Council working on financial sector policies, and many were actually not supportive of the reform. So the dialogue among the different agencies was not effective and leading to the stalemate that we discussed. Why was this dialogue not effective? Largely, USAID realized because each party was actually using its own source of information and probably biased information. There was absolutely no efficient collaboration among the agencies. So here we have a typical example of a system where the dynamics don't work. The system where, this equilibrium does not allow it to perform correctly. The main constraint, yes, is the inadequate policy, and this is what we want to improve, to remove, but the root causes are different. They are invisible. They are the incentives and the relationship issues among the government agencies. So what did systemic change look like here? The first step, adopt. To generate a change that would be sustainable, USAID wanted to address those root causes, those invisible incentive and relationship issues. So their innovation, the adopt phase, consisted in getting this new policy in place. But instead of directly helping the Council to draft a new policy, they aimed at changing the policy-making process to improve the dynamics among policymakers, among those government agencies, and eventually help address the conflicting opinions. So to do that, their program, which is at the bottom of your slide, had mostly two main components. The first one, providing evidence. They call that data versus dogma. I like it quite a lot. Using data to inform regulation. So the USAID supported the Council to conduct several policy studies and assess the efficiency of the directed credit programs. Because for years before, the proponents of this program they really believed that the targeted lending would ensure funds reached low-income populations. But now this new empirical analysis funded by USAID demonstrated that these programs not only failed to reach the target populations, but they were actually preventing other actors like microfinance institutions from reaching them. So the Council and the USAID program widely shared the results through workshops, direct advocacy, and even in the media. The second component of the program was to develop a collaborative policymaking process. A standard regulatory process would have had maybe the Council draft policies and request comments from other actors. And this is actually what they had been trying to do before. Instead, USAID recommended to the Council to create working groups and promote consultation with government agencies, private sector, and also the rural population. So I won't go into the details. You have more information on how they developed this consultation, a lot of interesting ideas in the documents. Molly shared the link in the chat box. But this new process played a really critical role in reaching a truly shared vision for the sector. So now going bottom up on the slide, this new information and collaborative process convinced the policymakers of the benefits of changing their initial views and practices. So this change in attitude led them to actively participate in the research, to analyze issues, and to come up with solutions. This new practice, this new evidence-based and collaborative policymaking process led them to adopt a new national microfinance strategy that was promoting private sector engagement rather than state-directed credit schemes. So exactly what the government had been trying to promote for years and failing to do so, working on the incentives, the information, the relationships, building trust, consultation, etc., USAID and mostly the Council managed to get to this innovation within less than a year. So this is our adopt phase, working on the root causes to promote innovation. Now we want the partner, which is the Council in this case, to sustain this behavior change. What could that mean for a reform process, for a new policy? So starting from the bottom of your slide again, you have the new practice, the evidence-based and consultative policy-making process. Will the Council sustain this practice? Yes, they did. This change in practices was actually institutionalized and affected policy formulation practices in the long term, beyond this first microfinance strategy in 1997. It even became a standard for financial sector reform, and it was used up to maybe today, I'm not sure, but at least it was used in 2010 for the National Strategy for Microinsurance, and in 2015 for the National Strategy for Financial Inclusion, and they were specifically referring to the process back in 1997. And all of this happened without additional USAID support. So this is our adapt phase. We can see that the partner really adopted and built and continued to improve on the initial innovation. Now going to the scaling up phase, what do you think scaling up, crowding in could mean for regulation? Could that mean another financial sector policy or a bigger financial sector policy? Scaling up, what does that mean when you work at the rural level? Let's have a look. The first phase is expand. So we want other actors that perform a competing function to your partner to copy or add diversity. Competing function is not really clear in the case of working at the rural level. Here, what it means is that we will work with other regulators. So when you think about regulatory reform, this crowding in phase is actually very important for the policy reform to be successful. And you have many programs that fail at this stage because policy formulation, this new policy does only set the tone for the reform, but to truly change the system, the environment, the policy needs to be implemented. So let's go to the expand phase in more detail. This is about crowding in actors that perform the same function as our partner, so other regulators in this case. The policy implementation often involves several interrelated activities, like enacting a law, for instance. And those were beyond the control of the Council. So the Council had to work with other government agencies, other policymakers and regulators. USAID continued its technical assistance to the Council to indirectly support other government agencies, the Ministry of Finance, the Central Bank, the Cooperative Development Authority, and other agencies. They reviewed how the new policy affected their regulation. So for instance, the Cooperative Development Authority, who initially did not even support the reform, eventually took the lead in reforming the entire cooperative sector following the new financial sector policy. A second example, in 2001, 3 years after the new policy, a new General Banking Act was approved and incorporated all this private sector microfinance that was promoted by the policy. And the central bank continued to issue new regulations to enable banks to provide microfinance services in a safe and sustainable manner. So the expand phase did happen and enable this new policy to really be implemented. Now, now the response phase, that's our last phase, the fourth phase. This one aims at sustaining the scaling up, where we want to have non-competing actors adjust their practices. In this case, because we work at the rural levels, the non-competing actors are those, well, it consists in making sure that the supply functions, the supply and the demand of the financial services reacted and built on this new policy. So we have a new, more inclusive policy in place, and we want mostly the private sector to take advantage of this new policy and start working with the low-income population. Well, it was not so easy, and USAID anticipated it because, as we discussed previously, the rural banks were not so interested in low-income population. So they were not interested in cash-based lending, for instance, and they were in any case facing very serious capacity issues. So USAID decided to design another program to support this response phase and to get rural banks interested in providing high-quality microfinance services. And they did it. That you will also have more details in the case study, but USAID designed another program without any refinancing, only knowledge sharing, networking, capacity building, peer pressure, and by the end of this program, they had 332 rural banks who benefited for their technical assistance, and who were working on designing products for microfinance clients. But at the time of our case study, in 2016, there were 170 rural banks who were still involved, and they were serving 2.6 million customers, including more than 1.4 for microcredit. So we see that this program, well, of course, combined with the work of others, entirely changed the dynamics of the financial sector in the Philippines. It was not just about a new policy, but about regulators who accepted to work together, regulators who kept learning and innovating, and regulators who knew how to work with the private sector, and the private sector who understood the business potential and offered high-quality products. So a lot of changes at all levels of the system. Let's recap using the AAR framework. So the adopt phase, here it's not about a new financial product, it's about the initial innovation, the new financial sector policy that was adopted thanks to a new evidence-based and consultative process. Adapt. This is a step more towards sustainability. We want to see the partners sustaining this change. So here, without even additional support from USAID, it's the Council who kept using and improving the new reform process. This process became a standard for financial sector reforms and was still used a few years ago at least. Expand, pushing the boundaries of the innovation. Here we have other policymakers such as the Ministry of Finance, the Central Bank, the Cooperative Development Authority. They adapt their own regulations to fully implement the new policy. And the last phase, respond, the diffusion of the innovation beyond the regulation. So here we have retailers, rural banks, who start to serve the low-income rural population and who also play an active role in the policy process. So this is systemic change. You see, it's not just helping to draft a new regulation and thinking or hoping that it will trigger change directly in the system. Even if there is no additional support beyond the regulation, we want to make sure that it will be happening. So even if USAID worked behind the scene through just one actor, their program contributed to change the long-term behaviors of many more market actors. So that's all for our example. I just wanted to clarify how you could use the AAR framework. It's a very good tool to help break down the complexity of the change that we're trying to trigger. So you can use it first to articulate the vision of your program. You can ask at the adopt phase, will the innovation be tested and taken up, and how? Do you have a clear strategy for that? Adapt, will partners incorporate and build on the initial change? How? Extend, will competing market actors be enough informed, incentivized, capacitated to copy or adapt the innovation, and how? And the same question for the respond phase. So when using this framework, you will think about your strategy. Do you count on some organic demonstration effects for the expand phase and the respond phase to happen? Or do you already anticipate that you will need to maybe actively disseminate the results, increase visibility? In some cases, there will be a need for additional interventions. In some cases, true, it might happen organically, but that's mostly the exception rather than the rule. The second case where you can use the AAR is to monitor if change is happening. Because systems are dynamic, they're complex, and so the initial plans are rarely borne out in reality. So we do need to monitor what is happening, and we need to adapt as needed. So here you will be asking, has innovation been taken up? Is it viable? Are the partners building on this change? Are competing actors copying? Are non-competing actors adjusting their practices? So the AAR is really a useful tool to break complexity and articulate the program vision and monitor if change is happening. I hope these two examples helped you better understand how to use it, whether you're working at the core of the market or if you're working at the support function or the role level. If you had to just remember one thing, remember that the innovation that your program triggers is just one of the 4 phases that are needed to generate systemic change. So make sure you don't forget to plan for the 3 other ones when you are designing a project. Thank you. Molly, I will give back the presentation to you.
Thank you, Elise. So really interesting examples, I think. We have a couple more minutes before the scheduled end of our session. While I give another minute, just if anyone is typing out their question in the chat box, I just want to make a note that as we noted at the beginning of this webinar, this is connected with our e-learning course that we have available free online for anybody to complete and participate in. And so we're planning to do some future webinars over the next year that will be related to the systemic approach. And so definitely watch your inbox for announcements about those webinars as they're coming up. If there's specific topics that you are curious about and would like to see, please feel free to reach out to us and propose those. Also, just a reminder and encouragement plug to go check out the e-learning course if you have not already done so. The link is in the chat box up towards the beginning of the conversation. And I also think if any of you have, kind of whether you've used the AAR framework directly, whether you're planning to use it, or whether you just have kind of seen an example through your own work of a case that sort of fits that framework, I definitely would encourage you to reach out to us and share that. We're always looking for additional examples that we can kind of use as a good model for how this works in the real world. I don't see any questions in the chat box, but I will just kind of pose one of my own to get us all thinking here at the end of the webinar, especially related to Elise's last point that, it's not just about the innovation and that you really need to kind of be thinking about all of the other phases beyond that when you're undertaking a systemic change process. And so, Elise, I'm wondering if you have any kind of specific guidance or or thoughts on, what type of mindset, characteristics are important if someone is thinking about, implementing or going about the systemic approach in a project that they are working on?
Yeah, that's a big question.
It is, yes, but just some kind of high-level key, sort of starting point.
Well, we went very quickly through what systemic change is about, and as we highlighted, the AAR tries to break down the complexity, and when you look at the 4 boxes, it all looks very simple, but actually quite complex. So I would say the first thing that is required when you are trying to trigger systemic change, and you really have to be flexible and to adapt, because you never know what exactly will happen. If you look at your own life, you do make big plans, but you really don't know what's going to happen tomorrow, next week, next month, next year. And it's the same thing with your financial inclusion program. You cannot, especially if you work on changing, influencing the incentives, the relationship within a market. So you do need to monitor and to be very flexible and adapt to how you see the market is evolving. Another thing I would say is you have to accept to fail, because everything you will be doing won't work. And that's why for funders who adopt a systemic approach, we recommend to be testing several things at the same time, so that you can monitor what the best solution is, and continue like drop those that don't work and scale up those who work. So test, accept failure, learn from it, and scale what is working. Yeah, I would say those are the 2 key things, key procedures, system, cultural things that we need to work on when, as a funder, we want to adopt this approach. Flexibility and adaptability, and then learning from failure and testing several options.
That's really helpful, I think, as a way to get started. We do have a question that's come through the chat box. It's a big question. I don't know if we have time to get into the full detail of it, but concerning the role of subsidy, including TA, in the systemic change process. And so, is the goal to kind of get to a fully commercial basis in the end? And how do you help the transition in the mindset of the subsidy recipients? I would say that would be the partner role in our framework to graduate from grants and maybe move into some of those broader phases. Elise, do you want to maybe jump in on that one? You're on mute if you're talking.
Sorry, I couldn't see the question, but I'm sure you answered it pretty well.
I was just summarizing the question. So basically, I mean, I think it's a good question, and I think it's sort of, in my perspective, it's kind of getting at the brunt of what undertaking this framework is that, we're trying to get, I would say, moving into a case of sustainability that's not dependent on funder subsidy, funding that is not provided by, or that is, independent sources of funding that are either coming from the partner or otherwise kind of self-sustaining in the market. And I think, that's something that certainly it's not an easy process, and I don't think it's always a linear process.
Yeah. The TA issue is always a big one, because we've been using TA as an additional incentive. Like when we want to trigger behavior change, very often we say, well, let's provide TA so that they realize that there is another world out there, and they need to change the way they behave. But the problem is that when the grant money or the technical assistance is the incentive, then it's likely it won't trigger a sustainable change, because when the TA or the grant is removed, then the incentive is removed as well. So when you use TA, it really needs to be something that will unlock another incentive rather than creating a financial incentive. And it does make a big difference. So TA has a key role to play in systemic programs. And I don't think you should, we are not saying that it should be only on commercial basis, that's for sure. So it does have a key role to play, but we have to be very careful how we use it so that the TA doesn't become the incentive.
Excellent. Well, on that note, I think we'll close out our webinar for today, but if anyone has further questions, comments, feedback, anything, please feel free to reach out to us. We're really interested to hear from you and happy to connect further with anybody as interested. And so just a reminder, we will send out a link with the recording to this webinar, as well as some additional resources shortly in the next couple of days. So I want to thank all of you again. I want to thank Elise for joining us as a presenter, and all of you for joining as participants. I hope that you found some interesting learnings in this webinar and have some new things to take away with you and think about. And we hope to see you again, either on our e-learning course or here for another webinar again in the future. So thank you.
Thank you, everyone.